Hi, I'm Rob Bloomfield, and this is Accounting with Our Bare Hands, a series of videos that look at the mechanics of cost accounting. This video is called Applying Overhead. So when we last left our hero, we were in suspense because we had that suspense account. This was an account we had taken dollars out of a raw materials account, but we didn't know which particular job account to put them into. Was it, should it go into work in process for contract A with one client or contract B with another client? We were in suspense. We didn't know. So we put the dollars into the suspense account called manufacturing overhead. Okay, so now we're going to learn how we resolve that expense with the simplest type of cost accounting system that tries to isolate margins on a job-by-job basis. It's called a job order cost accounting system. Okay, so let's take a look here at our Queen's Cross, and I'm going to make the asset quadrant, the top left quadrant, particularly big because it's the only one that we're going to worry about. Okay, I'm actually going to just use this spot on the right where liabilities and equity normally go in order to write down some assumptions. So what we're going to do this time, rather than looking just at individual transactions, is we're going to wait till the last day of a month, say, and we're going to go through the process of saying, okay, now let's look at our records once the month is over, and what are all the debits and credits that we are going to make, okay, that for the entire month. These are called summary entries. In fact, in most businesses, there are entries made every day. Every time you do a little work, you're going to transfer some dollars, but we're going to keep it simple and just look at the summary entries over the month. Okay, so here's our Queen's Cross, and here are the assumptions that we're going to make. We're going to start with some projections. And projections are going to be very important because we're going to need to use estimates to take the overhead dollars, the indirect costs, and get them into our inventory accounts, our key cost objects, the reason that we're doing all this work. So we're going to make our first projection that we've got $100,000 of overhead in total for the month. Okay, so this is a projection of how much we're going to spend on all those costs that are not easy to allocate, to directly identify with a particular batch of gloves that we're making. So, for example, rent. Classic example, when you spend money on rent, you're going to have to credit cash and debit something, but you don't know whether that was for job A or job B or job C, so you're going to put it in the suspense account. So we project with rent and utilities and depreciation and the salaries of managers directly associated with production. All of these are overhead costs. They're also product costs. They do belong in inventory. They're not period costs. And here's going to be our simple rule for getting these dollars of overhead into our products. We're going to say, well, we project that we have a total of $100,000 of overhead, and we also project that we're going to have, for example, 5,000 direct labor hours. Okay? This is what's going to be called our overhead driver. It's the basis that we're going to use to apply overhead to individual jobs. Let me do the math first and then talk a little bit more about the logic here. What we're going to do is, now this 5,000 hours projection, that's called our activity base. we think we're going to spend $100,000 on indirect costs, overhead costs, and we think we're going to have 5,000 hours of direct labor, which means that now we have something that that we can identify on a job-by-job basis. Direct means that when someone works an hour, we know which job they're working on because we're recording that. We're going to divide the projected overhead by this activity base, and that is going to give us, if you just divide this out, you end up with what's called a predetermined overhead rate of $20 per direct labor hour. Okay, $20 per direct labor hour. So this is an estimate. If you just say, oh, well, on average, every time we actually incur a labor hour, a worker works on a particular job for an hour. If we give that job $20 of cost, then if everything goes as planned, we will have spread our $100,000 of overhead over all 5,000 direct labor hours. Okay. So let's see how this works in practice. Let's make another set of assumptions that job A actually has 4,000 direct labor hours and job B has 2,000 direct labor hours for a total of 6,000. So you can see that not everything went as planned, not too surprising, whatever does. But now we have the information that, pretty much all the information that we need to make these entries. Actually, there is some stuff we don't know. We don't know how much each labor hour cost. So we're not going to worry about accounting for the direct costs, only the indirect costs. Okay, I'm going to make one more assumption, and let's just say for simplicity, every time we incur overhead, so I'm only making the entries for all our overhead, and let's just say we pay our rent in cash, and we pay our utilities in cash, and our managerial production staff in cash, and so on and so forth. And let's just assume that we have $90,000 of actual expenses. Now, that also didn't go exactly as projected. Okay? Again, what does? If you're wondering where the $90,000 came from, I just made it up. That's where it came from. Now, what are we going to do with this $90,000? We're going to put that into our suspense account, into our manufacturing overhead account, because we don't yet know which job it's supposed to go to. So this is called the incurrence. Right? The left side of the manufacturing overhead account is how much we incurred in overhead. The right side is going to be how much we applied. Actually, let me write that up here, because we're going to have to use a fair bit of space to do the calculation. Now, how of these dollars, right, we've got to take dollars out of manufacturing overhead and get them into our two key cost objects. Work in process account A and work in process account B. So here's one contract with one customer. It's a pretty big contract. It takes 4,000 direct labor hours. And we use, in this accounting system, a very simple rule for getting those dollars into the inventory. It's just $20 an hour. So we've got 4,000 hours at $20 per hour, so that's 80,000, and that's going to go into job A. And we've got 2,000 hours at $20 per hour, so that's $40,000. And we're going to take that out of manufacturing overhead and put that into job B. Okay? So now we have successfully resolved the suspense in our manufacturing overhead account. We put that $90,000 of overhead in there when we incurred it because we didn't know when we got our, when we paid our rent, when we paid our utilities and our insurance. We didn't know which particular glove that dollar was for. We put it into our suspense account, and then we used this very simple rule. Our predetermined overhead rate of $20 per direct labor hour, and that told us, well, since this had 4,000 hours, 80,000 go into the account for work in process of job A. Job B took 2,000 hours, so it gets 2,000 at $20 an hour, and that gets 40,000. Okay, so this is the application of overhead, and just a few things that are really important to remember. In our manufacturing overhead account, when we put the dollars in is when we incur the overhead. So the left side is what we incur, the right side is what we apply. We created a very simple rule to figure out how much to apply, taking it out of overhead and putting it into work in process. And that rule was just determined by projecting our overhead and determining an activity base, really how many labor hours we think we're going to have in total for the period. And then we just divide the projected overhead by the activity base to get our predetermined overhead rate. It's predetermined because we actually determine this at the very beginning, on the first day of the month, so that as every day goes by and we incur 1 hour of labor, we can apply some overhead, crediting the manufacturing overhead account and debiting work in process. One last thing I want to share with you before we go is you will notice that I tend to write the credits first and the debits second. And in most classes that you have taken, you probably, you always hear debit, credit, debit, credit. No one says credit, debit, unless they're in cost accounting. It's very useful in cost accounting to think of the credits first because you can see how these costs flow through the system. We use up this cash resource, that's a credit, and we put it into manufacturing overhead. We apply the manufacturing overhead, that's a credit, and we put it into our work in process accounts. So if you really think of the flow of the dollars, it's from crediting one account to debiting another. So I tend to think about the credits first. They're also usually easier. If you're told you just spent $100,000 or $90,000 on utilities and rent, you want to credit your utilities and rent account. The hard part is knowing what to debit. Where do the dollars go? So do the easy part first and deal with the hard part later. Okay. So this is just a brief run through of how to apply overhead to goods. You'll notice that the first step is to calculate a predetermined overhead rate. The second step is to recognize the incurrence of overhead. And the third step is to apply overhead by taking it out of the manufacturing overhead account and putting it into the work in process account. I hope that you've enjoyed this short video on applying overhead and found it helpful, and I encourage you to take a look at the other ones as well. Thanks a lot. Bye-bye.